Let's talk about 4 cheap stocks. Now, of course, cheap is subjective. For me, this might look cheap. For you, it might look expensive. I'm going to try and make the case here for each and every company. No, these are not 4 same stocks that we've been talking about over and over again. PayPal, Palantir, Tesla, Amazon, this and that. No, actually companies also outside the tech sector, which I think some of you might like, some not, and that's okay. Before doing so, hit all the buttons, like, subscribe, notification bell, do all of that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, first company I want to touch on is a company that, of course, was hit extremely hard during the pandemic. Why is that? Well, because it's an airline. Oh, you're talking about airlines now? What the heck is this? Yes, I'm going to talk about airline. That's stock number 1. Now, of course, airlines have already seen quite a recovery in travel since the reopening, let's say, of the economy, the reopening of the world. But I'm going to show you that financially, they're actually doing quite well as well, and it's not going to stop anytime soon. First up, some comments here. Airline execs forecast a record summer and a rise in demand for first class. Despite recent negative attention due to safety concerns within the airline industry, executives say that there is no indication of decreased flight demand. On the earnings call, Chief Commercial Officer Andrew Nocella said that as an airline and as an industry, United Airlines will carry record numbers of travelers this summer. The week beforehand, CEO of Delta Airlines said demand continues to be strong and we see a record spring and summer travel season, with our 11 highest sales days in our history all occurring this calendar year. And so, yes, I'm going to talk about Delta. Now, there's also Southwest Airlines, ticker symbol LUV. There is an activist investor, Elliott. I think they took a stake of about $2 billion. So there's definitely some value to be seen. Now, with regards to the comeback, you can clearly see it here with regards to jet fuel. So evolution of jet fuel demand compared with 2019, we're now actually above levels pre-pandemic. If we look at revenue in the whole airline industry, this is in trillions of dollars. So right now in 2024, it's expected to be $630 billion generated, could reach $730 billion by 2028. With regards to ARPU, doesn't really grow that much, which is one of the reasons why a lot of people don't invest in airlines because, well, they don't tend to be extremely profitable. So ARPU grows a little bit, but not that much. Penetration rate is expected to go from 14% in 2024 to 14.9% in 2028. And so, looking at Delta specifically, their last quarter, they delivered industry-leading operational performance, record March quarter completion factor, March quarter revenue and earnings at the high end of their guidance. They expect record June quarter revenue, mid-teens operating margin, and EPS of $2.20 to $2.50. They're reiterating 2024 outlook for EPS of $6 to $7 and free cash flow of $3 to $4 billion. With regards to balance sheet cash and liquidity, Delta delivered $1.4 billion of free cash flow in that quarter after paying over $1 billion in profit sharing to their employees and reinvesting $1.1 billion in the business. They repaid nearly $1 billion of debt in that quarter with a 2.9 times of leverage. They expect to repay at least $4 billion of debt this year and are on track to improve full-year leverage. Their commitment to strengthening the balance sheet was recognized this quarter with positive outlook updates from Moody's and Fitch, making their continued progress towards an investment-grade rating. And if we look at the profile as a whole, forward PE 8 times, EV to sales 0.9 times, EV to EBITDA 5.7 times. Of course, if you look at total debt, they've taken on quite a lot to survive during that pandemic, but since then they have been continuously reducing that, which is always great to see. Still a long way to go. With regards to the analysts' expectations for the coming fiscal years, including fiscal year 2024, sales growth of around 3.6%, EPS growth 6.6%. But if we look at fiscal year 25 and 26, EPS is expected to grow around 14% year over year. Sales growth, not that much. In fiscal year 2025, 1.3% growth year over year. Fiscal year 2026, 4.3% year over year. So here again is a story of a company becoming more and more profitable. Year to date, the stock is already up 26%. Year over year, stock is up 33.7%. If we look at its valuation compared to its 5-year mean, forward PE, EV to EBITDA, price to sales, price to free cash flow, it's all lower than the 5-year mean. Of course, that's because you had that pandemic period where all of these profitability metrics were blown out of the water since profitability was thrown out of the window. So you have to take that into consideration. Price earnings to growth is under 1. But overall, you can clearly see that the business is back on track. It's actually generating more revenues now than it did pre-pandemic. Gross profit is back to those levels, net income's back to those levels as well. Free cash flow still has a way to go, but you can clearly see that the recovery has happened and the business could be doing better in the future. Now, of course, you have to take the risk into consideration, the risk of, well, the economy not going into the right direction. People already spent all of their savings, they're in debt. If the economy is not growing anymore, if you're going to a recession or you're seeing stagflation, then yes, it could hurt a business such as Delta. So that has to be one of the risk factors you take into consideration. Then moving to the next company. The next company is also in the travel sector. We've talked about one of their competitors in the last video. So yes, I'm again going to talk about a cruise company. What, going from airlines to cruises? What is the 2020 again? Well, no, it's actually 2024, which is exactly why these companies are on the list. Just because once they were a meme investment, because you could have made quite a lot of money in 2020, 2021 trading airlines and cruises, but the business was obviously suffering. But right now, the business is doing much better, yet exactly with cruises, because airlines, we've seen some recovery there, but cruises, not that much. And so I'm going to talk about NCLH, Norwegian Cruise Line, which this is the profile right now. Forward PE 11.8 times, EV to EBITDA next 12 months 2.3 times, EV to EBITDA 9.2 times. Here as well, they've taken on quite a lot of debt. Yes, it has been reduced a little bit, but as the company becomes more and more profitable, which the analysts are expecting it to happen, right? EPS growth each and every fiscal year, quite a lot. I expect that debt to be repaid over time. Of course, this makes shareholder value increase. If we look at a comment from the president and CEO of Norwegian Cruise Line, we kicked off 2024 with impressive momentum with record bookings in the first quarter, propelling us to continue our all-time high booked position and an unprecedented level of advanced ticket sales. This also, by the way, protects them from an economic downturn in the next couple of months and quarters, since people book that in advance. These achievements demonstrate the continued growing demand we are experiencing for our product and offerings, which is why you're seeing the Q1 results being, let's say, better than expected, if not in line. And the same could be said for Q2 and fiscal year 2024, in line or better than expected. They also said that they're focused on de-risking and reducing the leverage since Q4 2023 to what they expect in 2024, net leverage expected to decrease by around 1.5 times. They're executing on a multi-year plan to reduce net leverage levels and de-risk balance sheet to drive shareholder value. They expect significant organic reduction in net leverage from current levels driven by ongoing cash generation and scheduled amortization payments. Of course, it's always great to hear. Execution is key. And again, things can change if an economic downturn happens, and if it's a long one or a short one, that should affect and will probably affect a company like those cruise companies or airlines. And so looking at NCLH right now, the stock is down close to 13% year to date and flat-ish year over year, has a market cap of $7.49 billion. But here as well, you can see a clear recovery in sales, in revenue, even higher than before. Free cash flow still not positive in the last 12 months. We still need to get back to free cash flow generation, just like pre-pandemic. But gross profit is already back to the levels pre-pandemic. Net income has turned positive now. And if they continue the current trends, I do expect all of these metrics to turn more and more green. And if we look at the forward PE, EV to EBITDA, price to sales, price to free cash flow, well, price to free cash flow, since there's no free cash flow, there's nothing to see here. But all the rest Yes, again, it is lower than a 5-year mean. So we are, in my opinion, in a good place, especially since the stock hasn't really moved that much, yet the business has almost recovered to pre-pandemic levels, right? You can see that here. 5-year performance of the stock, it's down 66.8%, which might be a reason why the average analyst price target sits 25.4% higher than the price we're at today. So that was company number 2. Now, again, might not be your cup of tea, and that's completely fine. A lot of us are just tech focused, so we are missing out, not missing out, but not looking at other alternatives, which in my opinion, cruises could be one of those. Do let me know down in the comment section below. Now, moving back to a bit more, let's say, tech-related, fintech in this case, and that's dLocal. Now, we've talked about dLocal before, we've covered the earnings report, but dLocal keeps on going down. They've been hit quite hard, especially after the weak quarter that they've announced, plus saying that for guidance in 2024, they expect to be on track, but meet the lower end of that guidance. So right now, we have a forward PE of 15 times, EV to sales 1.8 times, EV to EBITDA 6.6 times. The average analyst price target sits 88% higher than the price it is today. Of course, price targets can change over time. But this is a company that barely has any debt, if not zero. It is still growing quite fast. Yes, growth is expected to decelerate. Sales growth going from 32% fiscal year 2024 down to around 30% in fiscal year 2025 and then 23.6% in fiscal year 2026. But on the flip side, yes, EPS is also one of the main reasons why the stock is down a lot. EPS is expected to drop 21.4% in fiscal year 2024, but then reaccelerate and growing 53.6% year over year in fiscal year 2025, followed by another close to 33% growth in fiscal year 2026. Still a fast growing company and a profitable one as well. And so last quarter, these were the results. By the way, they also announced a buyback of $200 million. It might not seem a lot for you, but the market cap of this company is not that much either. So right now, you've got here a high growing company, but yes, in the meantime, they expect to get hit with regards to profitability. Gross profit is only up 2%. Gross profit margin is down 11 percentage points year over year. Adjusted EBITDA down 19% year over year. Profit down 50% year over year. So that's why the stock got hit quite hard. And so if you look at the performance right now, year to date, it's down 56%. Year over year, it's down 33.5%. Has a market cap of $2.2 billion. So that $200 million in share buyback can retire quite a lot of shares. Now, today, at the time of making this video, stock is down another 3.89%. And so right now, if you look at the, let's say, 5-year, well, it's the 3-year mean, we are much, much lower on all of those metrics. And yet the company is bigger than before. Now, of course, last year, I believe it was last year, there was also a short seller report that came out and accused them of some shady, let's say, reporting with regards to TPV, etc., etc. But if that was the case, if this company was fraudulent, wouldn't we see a lot of damage in the brand? Wouldn't we see a lot of damage with regards to growth rate? I'm not talking about the profitability side of things because that side has actually, well, it's a short-term hit that the company has said this quarter and last quarter that was going to happen. Same thing as Adyen. Plus, the new CEO was Mercado Libre's previous CFO. I trust him 100%, well, 100%, let's say 99%, that he's not a fraud, that he would not have joined dLocal if he thought it would be a fraudulent company. So maybe right now that's also weighing on this business, changing management, having to prove the doubters wrong, the market's wrong, hitting profitability. Maybe analysts know something that we don't, and that's why we're seeing more weakness in the stock. Could be. But right now, I trust the new management team. I think we're still seeing quite a lot of growth for a company that's still profitable, basically zero debt, trading at these valuations. In my opinion, that is the definition of cheap. Can be completely wrong, of course. Now, moving into the last stock, which is also a company in that area. You probably already know which one that is. I've just said the previous CFO comes from there. Yes, it's Mercado Libre. Now, Mercado Libre, of course, is not being defined now as being cheap because, like I said, cheap is subjective. One stock, one share will cost you quite a lot, so that's not cheap. Valuation wise, as you will see, might not be cheap either, but in my opinion, as you will see, it could be categorized as cheap. Because right now, forward PE 43.7 times, EV to sales 3.9 times, EV to EBITDA 22 times. That's in the next 12 months. Average analyst price target sits 23% higher than the price we're at today. And look at what the analysts are expecting this company to do in the next coming fiscal years. Top and bottom line. I mean, if that's not tremendous growth, then I don't know what is. And that's why I do think that this premium, in my opinion, is granted. If we look at their performance in the first quarter, GMV, $11.4 billion, up 20% year over year. Items sold up 25% year over year. Total TPV up 35% year over year. Credit portfolio up 46% year over year. Net revenue up 36% year over year. Income from operations $528 million, 12.2% margin. Net income $344 million with a 7.9% margin and increasing. Why do I think it is still cheap? Well, if you look at what this company has done in the last 10 years, it has grown and it has grown quite fast in a very, very profitable way. Well, it's become now very, very profitable. And despite the stock being up quite a lot all these years, despite the stock being up 33% year over year, only 2.2% year to date. If we look at forward PE, EV to EBITDA, price to sales, price to free cash flow, price earnings to growth, compared to the 10-year mean in this case, because there was a huge portion of that era, let's say, where the company was just not profitable. So you have to take what happens before. It is much lower. So yes, again, I think it is cheap. Could the stock drop a bit more? I would love to buy this stock at a lower price, but you will always pay a premium for great companies. And I think Mercado Libre definitely fits the category of great company, great leadership. So overall, that's about it. Those are the 4 companies, 4 stocks I wanted to cover today. Of course, share your thoughts, share your picks down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.